BTalk.
Have you heard this idea about the Robin Hood bankers' tax?
Yes. It's a sweet little idea, taxing the banks to help the poor, but I don't think it'll work. It's very complicated and would be very tough on the banking sector.
Which has just been given billions of pounds of taxpayers' money to keep it going.
Well, yeah, of course.
And is still paying itself billions of pounds in bonuses.
Yes.
Of course, we didn't bail out the banks except with guarantees here in Australia. But in the UK, the notion of a Robin Hood tax applied to the banks has been getting some traction, thanks in part to the involvement of high-profile people like actors Bill Nighy, who we heard there, Emma Thompson, Sienna Miller, and Ben Kingsley. And here in Australia, comedian Julian Morrow has thrown his weight behind it. So has Tim Costello from World Vision, and Ross Buckley, who's the Professor of International Financial Law at the University of New South Wales. And Ross is on the line. Now, Ross, this tax, it's basically a tax on banks, isn't it? Can you explain the logic behind it?
It's much more, Phil, a tax on hedge funds and investment banks than it is on commercial banks. The idea is a very tiny levy, 1/20th of 1% on all wholesale capital market transactions. So, to the extent, one of the big four banks takes money from depositors and lends it to borrowers, there's no tax payable. To the extent the same bank goes into the capital markets to borrow the money that it lends somebody on a home loan, there's 5 basis points, 1/20th of 1% payable.
So why target the investment banks?
Because it's their trading which is making our international financial markets far less efficient and far more unstable than they used to be. I mean, really, the sort of trading this is targeted at, estimates in Europe are that about 40% of financial market trades, the buy, the hold and the sell, all happen in under 1 second. So it's really focused on nanosecond trading, which is driven by computers. There's no human mind brought to bear. For instance, recently in Europe, most of the French hedge funds have moved their computers to London from Paris because the time it took, the messages to travel over the wires from Paris to London were putting them at a disadvantage. It's that sort of trading that this will impact most on, because it's the same size tax whether you're making the trade for 2 seconds or 2 years. You pay the same amount.
Right. So the intention is to try and slow this down. So there's a bit more rationale in the decision making rather than just seeing that a price is moving and instantly acting on it automatically, as you say, by a computer program.
Exactly. The idea is to get markets to trade on fundamentals, much more than just on the last 30 minutes or 30 seconds of movement in the market, which is, what they're trading on now. I mean, markets do a really important job. They set prices, and we need them to set prices to allocate resources effectively. And, there's a lot of evidence now that these computer-generated trades are making markets far less effective at setting prices.
And I guess that we see the extremities, which is the danger, isn't it? I mean, if there's a bit more reasoning and there's a bit more human intervention, then we won't see those extremities. Is that the thinking?
That's the thinking, and that's really what the thinking, behind the economist who first dreamed up this, the precursor to this tax 40 years ago. So it's a very unusual tax in that it's been conceived not to raise money, but to improve the operating of markets, and the revenue you get from it, therefore, is a bonus, to be applied as governments choose.
Now, do we know how much revenue? I mean, there's in the Bill Nighy, which is a great video, the Bill Nighy video in the UK, they're talking about astronomical numbers, but presumably those numbers this is how much money would be raised if we don't change behaviour. But what you're saying is that
those numbers, amazingly, are if we do change behaviour.
Oh, really?
All of the estimates assume, I mean, in the figures that we've run, we assume 2/3 of trades will be dissuaded. So it'll shrink the size of the market by 2/3. And even doing that globally, conservative estimate is 300 billion to 400 billion a year. So most people have no understanding of the size of the financial markets anymore.
Yeah.
In the last 20 years. I mean, 30 years ago, most money moved around the planet to pay for trade in goods. Australia sent money to Japan because we imported Toyota cars. These days, trade in goods accounts for less than 1% of the money that moves around. Money moves for its own speculative investment purposes.
So are there any downsides? I mean, you're talking about distorting behaviour in a good way. I mean, could there be a flip side?
Well, I mean, obviously the hedge funds and the investment banks will argue there is because they like the profits that come
For
from
sure.
the current arrangement. But I don't think there is very many downsides. I mean, the bottom line is that this financial sector is not taxed very much at all. Another reason to have this tax is to have a more equitable allocation of taxes. Because, of course, if you have some sectors that are taxed less than others, resources should logically flow into those sectors. And that's what we've seen in Australia. Assets under management of hedge funds increased by 30 times, a factor of 30 times, 3,000% in 5 years in the last decade. And it's because they don't pay as much tax as other forms of investment vehicles.
Right, but anybody who gets taxed more, obviously they've got a choice that they either will accept the fact that they're going to make less money ultimately, or they try and try and get back that margin by passing the cost on in some way, and obviously it ultimately gets back to the consumer, however long the chain. Is there a danger that that can happen?
That would happen in a small way. I mean, for a bank that raises its funds in the capital markets, this would increase the cost of credit in Australia by 5 basis points, 0.05%. But most of the trading that this is targeted at is hedge funds and investment banks trading for their own account. So there isn't, most of this there isn't necessarily a customer. The customer is the financial institution.
Yeah.
And so in that sense, this will just directly decrease their profits. There isn't really scope to pass it on to anybody.
Now, Ross, I see a parallel here. It affects their shareholders, of course, in the same way that the mining tax would be a great thing if you weren't a mining shareholder.
That's
so,
right.
The mining tax, obviously, arguably brought down a prime minister. It seems like this would be a similar political hard sell, even though that most people really don't like investment banks very much. It would be a hard concept to sell, wouldn't it?
Depends which country you're selling it in. I mean, there's about a dozen countries led by France and Germany that have committed to a even smaller level of half a basis point, and even half a basis point. So 0.005% raises about $50 billion a year.
Yeah.
And France and Germany are both very keen on the idea and have been for a long time. So politically, obviously, it's not such a hard sell in those countries. It is a very hard sell, I think, in Australia. I think the Australian government, even before the mining tax, were very leery of doing anything to upset the big four banks, and they'd be even more concerned about it now, as you rightly point out. But even the US, under Obama, is imposing a different form of levy on banks and is proceeding to do that right now. So the idea that banks should be taxed more than they are at the moment is not that radical an idea. Frankly, there's only 3 countries in the world that oppose it, and that's Australia, Canada and Russia. But most other countries in the G20, I think all other countries in the G20, accept the idea that their financial sectors are not taxed sufficiently for it to be fair, and are taking different steps to address that.
The way it's been pitched, I was, in preparation to talking to you today, I was going to start saying, well, look, if the intention is to raise more foreign aid, why don't we just do that with, more money from government coffers? That sounds like the most efficient way. And that's pretty much the way that it's been pitched, isn't it? If we take more money out of investment banks, look what good we can do for the third world. What you're painting is a very different picture, which is that, no, look, this is a sector that needs control, and the spin-off benefit is that we've got some money that we've got something to do with, so let's give it to the third world.
Well, I think that's right. I think civil society globally have got behind this because their interest is the plight of very poor countries. But the historical genesis of the idea, why this idea was conceived of, was to improve the operation of markets. And given we live in the real world today, Australia is incredibly lucky. Most OECD countries have budgets that are in tatters. The need to bail out their financial sectors and to re-stimulate their economies blew huge holes in the budgets of most rich countries that they have no way of trying to fill. So, I would think that if we proceeded, and this is frankly why countries like France and Germany and others are interested in these ideas, because they know they're in a budgetary crisis and they need new forms of revenue. So I think part of it would go for global public goods, for helping poor countries, but part of it needs to go to help the rich countries repair the damage that's been done by the GFC.
Yeah, absolutely. I guess the practicality of how this is applied. I mean, you've said yourself, software, computers are driving a lot of these transactions. It is a highly computerized industry. It would be relatively straightforward. It's almost like a software upgrade to try and implement this, isn't it?
That's one of the big changes in the last 20 years. 20 years ago, this was quite a difficult tax to impose because settlement and clearing was done on lots of different and diverse proprietary systems. But now, the great majority of settlement and clearing is done in about only 2 computerised exchanges for most financial transactions. So it's very easy tax to impose and a very difficult tax to avoid because the exchanges that have centralised all this activity are so efficient that moving to any other form of settlement and clearing would be much more expensive than this tax would be. So it's the computers have really made doing this very, very easy.
And given the nature of international trades, I mean, does every country have to take part for this really to work?
Yeah, that's one of the hot questions. I mean, Europe doesn't believe so. Europe believes that it could do it itself, but the catch in Europe is Britain. If Britain didn't sign up, I don't think continental Europe could do it because the trades would just emigrate across the channel. But there's all sorts of reasons why, if Europe imposed this tax, the trading would not all migrate to North America. Reasons of time zones and infrastructure and all the rest of it. And if you look at the world's financial centres, I mean, the 2 major ones, New York and London, are very heavily taxed in all sorts of ways already. New York is a very high tax place to do business in a relatively low tax country, the United States. So, business doesn't tend to move to avoid small taxes. There's other really strong reasons for financial institutions to be in those leading centres.
So do you think it will get up in Europe?
Some form of bank levy is being imposed, and one of the pities is that the latest G20 in Toronto agreed that different countries could do their own thing. It would have been nothing better to have something far more uniform. So I think we will see some form of levy on banks calculated by different means in Europe and in the United States. The Australian government is not keen because it argues fallaciously, in my view, that the Australian banks manage their own way through the latest crisis and don't deserve to be, quote unquote, punished with any sort of tax. This idea of a financial tax is a bank levy only takes money away from the banks. It doesn't change their behaviour, and it doesn't raise as much money as this does. So this is a bigger call. It raises more money, and it has a much more beneficial impact on markets, and it's less easy to quantify exactly how big an impact it will have, which is one of the reasons the banks resisted. So I think this is more of a medium-term project than a short-term project.
Yeah, saving the traders from themselves almost, isn't it, really?
No, I don't. I mean, traders love volatility, and traders make a vast amounts of money out of it. I mean, just extraordinary amounts of money out of it. In the year that ended in April, the financial year in the US, which ended in April 2010, the 25 top traders in New York made an average of $1 billion each. 25 individuals took home $25 billion. The top trader took home $4 billion himself. So they're making a huge amount of money out of this. Part of the problem is what Alastair Turner, the head of the Financial Services Authority in Britain, described. He used the term socially useless.
Yeah.
All of this that is going on has no benefit to society.
No, they produce nothing.
They produce absolutely nothing, and frankly, it is just gambling. And if you go back 20 or 30 years, we had statutes in most countries that limited gambling to the racetrack and carefully limited it to a few prescribed casinos. But in the last 20 years, we have allowed gambling to dominate, and it absolutely does, in volume terms, dominate all of our financial markets. And it uses a lot of resources, it causes a lot of volatility, and the payoff to society is a big fat nothing.
Yeah. Sounds great. Good idea. Appreciate your time, Ross. Good to talk to you.
Okay, thanks, Phil.
Unlikely, though, isn't it? I mean, Julia Gillard isn't going to brave it, that's for sure. Not after the mining tax. And Gordon Brown, well, I think he was behind it in the UK, but who cares what he thinks anymore? They've got a whole new government there too. But it does seem to make a lot of sense. Now, next time, the